Hello and welcome, and time for another update video regarding the strategy that I've been talking about as I had a video on April the 11th, the new trading method, buy low, sell high, 13-minute video. And then the next day, April the 12th, buy low, sell high, crypto trading method explained. And within this video, I'm going to go deeper, talk about some more advanced, but not too advanced topics within this strategy. And I originally used a spreadsheet in the first video and included 9 different codes from December the 31st, 2016 through April the 11th of this year, and seen how it would do based on just holding it and then trading it. So obviously you should have already seen that video. If you haven't, I would definitely urge you to check those out beforehand. So I've increased this to 25 different codes, and the list would be AMP, Ardor, EMC2, Ethereum Classic, Litecoin, Artbyte. These are the ones from before. Black Coin, Cloak, Crown Coin, Dash, Gigabyte, Doge, Ethereum, FTC, Feathercoin, Lisk, NXT, OK Cash, Solus, Steam, Stratus, Stellar Lumen, Monero, Ripple, ZCL, or Z Classic that is, and ZEC. So a list of 25 different ones. Last time I entered 0.1 Bitcoin per code. This one is not going to use that much. It's going to use 0.04 because that means it would be like starting with 1 Bitcoin. So therefore each code would start with that amount. There's the ownership for each one, what the value is, and we can see on the second day that, well, the market went down on the first day of January of that day. So all the information in here. So how well did this do? Last time it did phenomenally well. In fact, it was even, I had one small carrying the one mistake the last time. Let me just bring up that spreadsheet now. And it started with 0.9. Now this one's going to do better actually, which is actually pretty cool because there was a lot of codes that had just tremendous gains. But in this case, starting with 0.9, it outperformed the value 155 times. But I made a small mistake. In the average, I didn't average the Artbyte in. And that actually, the value levels were actually better than such. So it really doesn't matter how many codes, for the most part, I think you play. The more you have, the more diversified I think it is. But the bottom line is the markets have to go up to have tremendous gains. During these sideways runs, yes, profits will come into place, but yeah, that's generally speak how that would work. So then, let's look at this further. How well did the net result work out? Well, this is the HODL value. This is the trading value. So as the time went on, we can see with the right hand side being trading, you're overperforming the market, and well, that would continue to go on. There we can see 17 times versus 7 times, 34 times versus 12 times. Then the markets go down 28 times versus 8 times. Goes down some more, 19 times over 6. We're going to talk about the up and down trends because I've managed to make some charts with the movement of this. But when these things go up, you can see here, starting with 1 Bitcoin, and in less than a year or around a year's time, getting 100x gain from profiting. And of course, you've given away the profits back. But that's how that would look. Okay. So then, I've got some more statistics in here as well, but I'll get to this in a little bit. I want to show some charts first, however. And I've pasted the data into another spreadsheet just for the chart. So the 2 columns represents the stats from the previous page as far as the hodling versus trading. So that would be, which levels would that be? Let me just go and yeah, so it's these two columns in here. So I just copied and pasted that information over. That's not where I wanted to go to. This is, okay. This represents the amount that is gained or lost per day, with the first one representing that of, I don't remember actually. Well, the first one would be the hodling. So down 2.1%, but the other one was down 1.6. Column J with 1 and 0 binary numbers. 1 indicates if trading overperformed doing nothing that particular day. Because there were some days in which just doing nothing was more profitable or overperforming that of trading. Usually those would be days where the markets have amazing up moves, closing near the highs of the day, where in trading out you'd be selling it at so many different key points. Or of course this only traded once per day. It worked out that 61.5% of the days, better than 3 out of 5, you overperformed simply by trading into the market. So then, let's take a look at the charts. This is holding. So obviously the orange colored line represents that of trading. And the blue color, well, it didn't do quite as well. But it really makes it difficult to look at the entire line to see comparisons. So what I've done is I've separated this into each chart representing 2 months. So I'm going to start off. This is what the first 2 months would look like in January and February of 2017. So we take a look at the comparisons within such on, let's try to get this, so there we go. You can see the numbers on the bottom of the screen, and I'll make try to position it right. That works well. So then, from numbers about or period like 13 through here, the market goes sideways after the up move in blue. Well, this one makes a pattern of higher highs and higher lows. And even during this sideways pattern from rows 37 through 47 or so, this one was going sideways and this one was in an uptrend. So therefore, you can see how buying and selling was the secret to overperforming that market. So now let's move on to March and April's data. And March and April holders are hodlers stay with the traders but lose in the end. So here's a spot just for this time frame that over a 25-day period, the entire run of those periods, you would have been better off doing nothing than you were buying and selling everything that you did. Okay. But when it was all said and done, when this market had the big correction, well, not big correction, but when it went sideways with a little bit of a bias going down from rows 28 through rows 43, this one had a decent bias going up. And the interesting thing is when it hit its high at around this point in here, it went sideways where this one went down. However, this gain in here overlapped how the orange line was doing, but again, in the end, as if it's a battle, the orange won at the end. And then came May and June. Spoiler alert, the markets were very bullish then, so these numbers are going to get very, very high. So one unit in 2 months made spectacular gains either way you did it. You doubled your gains during the 2 months just by doing nothing. And you almost did 4 times better by buying and selling. So the end of the bull market has the hodlers not performing anywhere near as the traders would have. As we take a look at the next one, we'll take a look at just a major overperformance in this case. Now let's move into the next month, July and August. July and August see hodlers lose more than the traders. There are decent times of loss. There are decent times of losses with winning strategies, aka long-term gain. Meaning, you can go days, weeks, and months and see your portfolio go down. Here's a spot where your portfolio went from 1 unit and cut in half at one point, trading, cut to like losing over 60% just buying and holding. But this wasn't it for the decline, albeit trading won again, because September and October starts fine, but now 4 consecutive months of down actions. Traders continue to overperform in hodling, as we can see again how the orange line is doing better than how the blue one is. Let's move on as we leave September to October. We're going to November and December. Another spoiler alert. End of the year, markets did very, very well. So we're going to see a major rise. And there we have it. And at one point, buying and selling was not doing as well as holding because the markets were just going way higher. So you had situations where you had codes, you were selling at 500 Satoshi. Then the next day you were selling it at 650. Then the next day you sold at 720. Then the next day you sold at 1500. Yet just holding it meant you had spectacular gains because you didn't reduce your share size or coin sizes. So the hodlers lost their lead at the end of the game, as if this is one. But you can look at this like a horse race, and well, just at the stretch drive, we've seen the winner. But a beautiful situation here at the time frame, the end of the year of last year, how the cryptos were chopping up and down, yet you were destroying it, buying and selling. Major difference for positive, making the trades in that situation. Let's move on to the first 2 months of the year because they weren't too good. At least it didn't fall in, or didn't work out at the end to be so good. There we can see how it started the year off doing pretty good, and then it just went down. So therefore, bear market plays out. The hodlers, well, that's at like 0.85, so they lost 15%. And this one is a little over 0.15, so it went up, 17% rather, it was up 1.17. So there's a situation of winning rather than losing. And the final one, which is March until now, and I don't have the last few days. It doesn't make much of a difference, but it ends with hodlers again, lagging behind, as we can see within the down part of this move, where this goes down to like 0.66, 0.67. This goes down to like 0.77. Always starting these periods at 1, just to do a comparison to how each one does. The next thing I want to talk about is that percentages that I showed before this that I said I'd talk about later. Well, now it's later. So we're back to the first spreadsheet which calculated this. What this percentage number indicates is what percentage of your portfolio, in this case starting with 1 Bitcoin, was being traded. Now the portfolio always will change because it goes up, obviously. In this case it did. So you started with 1 Bitcoin, then it goes to 2, 3, 4, and so on and so forth. But how much of it did you trade? So if you traded 0.1 Bitcoin that day, with the portfolio worth 1 Bitcoin, you traded 10% of your portfolio. So we can see these numbers at 4 get to 11, 12, 6%. The lower numbers we can see here at 5 and 4. And of course, the higher percentages occur when the markets have more volatility and have more larger up and down moves, thus larger size trades. When you have a whole bunch of, like what we've been seeing lately, like 2%, 3%, 4% up and down days in the altcoins on the most part, then they're going to have lower percentages here. So you have different times where collectively you'll notice that you'll have higher volatility. Here's a spot where back in May of last year, the volatility during the up run was magnificent. So you had all of these higher percentage moves. 17%, nice large number. But then we can see how it tails off at times, gets lower. Here's 5%. And that's not much to trade on your portfolio overall. 2.82%. And we'll just scroll it down to the very bottom, and there's the 20% here. There's only, I think, one that went over 20%. That was the only one. But there we can see a lot of the lower ones now. And even recently here, they've all been low because lately the volatility has not been there. I have got, this hasn't been updated in a few, or I don't have data for the last few days on here because I originally started downloading this information on the 11th. So it's not really needed. I know the information is not going to change much. The average is 6.78% that this traded at per day, with the median at 6.04. Now, I've been using this trading method myself for several days, or a few days anyway. And my trading volume today, which was Monday, finished at 4.6%, which is relatively low. And then yesterday it was 3.8%. Saturday, 8.9%. And then Friday it was 9.6%. So I'm looking at a lot of these lower numbers in here. I realize I could probably get more trades in if I did a bit better or had more aggressive time to do orders. But the way I look at it is, if I'm able to get these percentage numbers on what I would predict is going to be one of these, it'd be like the 1.9 kind of days, because the markets haven't moved much today or yesterday. And they didn't even move that much on Friday and Saturday overall either. So by actually being active and getting more trades in, looking at the computer more than once per day, because this is all this did, was just take the closes every day, and that is it. So that's the equivalency of picking a time, maybe in the morning, in the afternoon, before you go to bed, whenever, and that's all you do once a day is you just buy up what was down too much and sell what is up too much, and then you're done for the day. And that would work. And this is pretty much exactly what you're doing here. But if you see it in the morning, if you see it in the afternoon, and you see it in the evening, then you can get many more trades, because you can play on the intraday level and see spots where you might buy and sell back and forth amongst one code a few times during the day, like I was able to do on the original 2 days with the higher percentages within Omi's Go, and a couple other ones that were active on those days. Let's continue on further. Let's talk about the order book, because small differences can make a good difference. And whether you're doing this for a buyer to sell, and it works either way. Now, first thing I want to point out is when markets are going higher, and that's when you're going to be wanting to sell, it's not that hard to sell and actually get good prices. And when markets are in a downtrend, it's not too hard to buy and get good prices. Now, I really got to explain what a good price is, of course. Let's assume that you got a code with a bid-ask ratio of, say, 11.10 and 11.19. If you're looking to sell, you would instantly take the 11.10. But only price pays, and the numbers do mean a lot. And the more often you can get a bit better of a deal, even if it's just marginal, the better long term this is going to work. So maybe you can stick a sell order in at 11.19 along with the person, or 11.18. And maybe you might want to try to get the 11.20, 11.30, 11.40, because after all, you are in an uptrend at that time. And the more often you're able to get this, then the more likely it is that you work. Now with Litecoin, I've been doing this for months and months and months. And I'm so used to seeing like 1/3 of a percent, 1/2 of a percent plus difference between the bid ask, that every single time I'm looking to buy, I'll just put a price in the bid order and usually wait, most times, more times than not, between 4 seconds and 4 minutes to buy it. The same thing when I'm trying to sell. Oftentimes I could do immediate. But again, even in an uptrend, what you'll notice is that you see it, you see our last trade was 1,080 or whatever, it's went higher. As time goes on, these markets can move fast, faster than I can type my orders in anyway. I'm not using any automation other than having a calculator or a spreadsheet figure the numbers out for me. But the next thing you know, when you're trying to say sell this, you see, this is at 11.10, now it's at 11.14, now it's at 11.18. This has gone up to like 11.24. And then you see this is at 11.22, that it does become very easy oftentimes for situations like this to come into play. Look at the order book for where there might be some interesting spots. Maybe there's a big sell wall at, say, 11.58. And you want to try and get that 11.57 or 56 number when you're trying to sell. Same thing on the buys. Maybe there's a big buy order at 1100 even. So you just want to try to put a buy order in for 1101. And as far as actual day trading is concerned, you can do a lot of this when playing this game as well. So you're playing a code of whatever, you've had the uptrend, you've been doing your buying and selling. Now if you get a pattern that says that you're probably going to go down, like say like in here, then maybe you might be like, okay, I'm at a spot where I would normally buy, because say once my portfolio is say 5%, 10%, 20%, whichever number you choose. 20% for me is a lot, but if you're 10% say lower than where your price point should be, then using technical analysis where you're at a spot where you're like, well, this is a good short situation. So instead of buying it where I usually would, at say 0.9 units worth normally 1, I'm going to wait for it to hit a lower target, and at this point it would be maybe worth 0.8. And within such, it's more profitable to buy just a double amount here than it would be to buy here and then buy again here. Same thing, of course, with sell targets. You're like, okay, there's a nice Fibonacci target where the market is supposed to go to, say, 850 Satoshi. Yet here we stand now at, say, 817. And I'm supposed to sell at this point. It's worth too much. Well, you know what? Maybe sometimes if you got indication that you'd want to wait, then you could do so. After all, the whole point of cryptocurrencies is you are in control of your own money, with cryptos being such. You are your own bank, especially when you work within hardware wallets and such, but you are in control of your own monies. You are in control of your own game and how you play it. I'm here to offer ideas and really share a lot, of course, what I'm doing within this kind of strategy. Alrighty then. I'd like to thank you for tuning in. Of course, any decisions you do is your own risk, own reward. I'm going through information purposes, and as a trader, as an investor, as a calculated gambler, the actual more tedious kind of work like this that you do, then the more experience, the more information you're going to have for yourself, the more understanding, and the more, the better off you're going to be as an advanced player. So then, have a great crypto day. Take care. Bye-bye.